Before we dive into the nitty-gritty, let's clarify what we mean by index funds and active investing. Index funds are a type of mutual fund or exchange-traded fund that aim to replicate the performance of a specific index, like the S&P 500. They do this by holding all or a representative sample of the securities in that index. The beauty of index funds lies in their simplicity and low costs, as they require minimal management. On the other hand, active investing involves a hands-on approach where portfolio managers actively pick and choose securities to buy and sell, aiming to outperform the market. This strategy often comes with higher fees due to the intensive research and management involved. Knowing these definitions sets the stage for our deeper exploration of their respective advantages and disadvantages.
When comparing index funds and active investing, performance is a key metric. Historically, studies have shown that most actively managed funds fail to outperform their benchmark indexes over the long term. A notable study by S&P Dow Jones Indices found that over a 15-year period, more than 80% of active funds underperformed their benchmarks. This raises an important question: if most active managers can't beat the market, why pay the higher fees? Index funds, with their lower expense ratios, often provide steady, reliable returns that closely track market performance. However, it's essential to note that while index funds may have lower volatility, they also lack the ability to react to market downturns like an active manager might. Therefore, understanding your risk tolerance and investment goals is crucial when considering these options. Cost is another crucial factor that differentiates index funds from active investing. Index funds typically have lower fees because they require less management. This translates to higher net returns for investors over time. For instance, imagine you have an index fund with an expense ratio of just 0.1%, while an actively managed fund charges 1%. Over 20 years, this seemingly small difference can lead to significant wealth accumulation. Not to mention, active funds may incur additional trading costs as managers frequently buy and sell securities. This can eat into your returns even further. Understanding these hidden costs is essential, as they can significantly impact your overall investment outcomes. Remember, low costs can be the key to long-term financial success.
Investing is inherently tied to risk and reward, and both index funds and active investing come with their unique risk profiles. Index funds offer broad market exposure, which can reduce individual stock risk, but expose you to market-wide downturns. They are generally considered less risky if you're investing for the long term. Conversely, active investing can provide opportunities for higher returns, especially in volatile markets. However, it also comes with the risk of significant losses if a manager's picks underperform. Moreover, the emotional toll of actively managing investments, watching daily price fluctuations, can lead to poor decision-making. It's important to assess your comfort level with market ups and downs when choosing between these strategies. Your investment horizon and financial goals should ultimately guide your choice.
So how do you decide between index funds and active investing? It ultimately depends on your financial goals, risk tolerance, and investment knowledge. If you're looking for a simple, cost-effective way to grow your wealth over time, index funds might be the best fit. They allow you to invest in the overall market without the stress of constant monitoring. On the other hand, if you enjoy research and believe you can outperform the market, or if you have specific sectors you want to target, active investing could be more suitable. It's also worth noting that a blended approach, using both index funds and actively managed funds, can provide balance and diversification. Whatever you choose, the key is to remain informed and committed to your investment strategy.